So this year we've had some nice volatility. Traders with long-term positive delta positions have suffered for a short period of time and then quickly recovered. If you're looking for a little bit of protection, especially in some of the volatility that we've seen, some people protect me, help. Some people are looking at stop orders. So we're going to look at spread trades, which are a different animal because you have a built-in stop loss already. So if you're looking to kind of scalp out of these, here are some things that we're going to look at here. So the study that we're looking at SPY 45 days until expiration, and we're looking at the past 10 years. We're looking at the 30-20 put spread in terms of delta. So these are, you have to keep in mind, these are very, very low these are low risk trades. We're talking 5 or 10 points wide for most of the last 5 or 6 years.
Yes.
Probably $3 or $4 wide before that. You have to keep in mind when you're doing delta studies and you look back at markets, and especially into the markets where they've gone basically straight up, your risk on an iron condor, a 30-20, was a lot different 10 years ago than it is right now. Market with the SPY is at 300.
Right.
Yeah. So your spread is 3 points wide versus now it's 10 points wide.
Twice as big. Yeah.
Twice as big.
Yeah.
So this skews it a little bit.
I mean, you got to think about it as we used to.
The relative premium, the percentage is the same.
Percentage is always going to be the same.
Always going to be the same.
But it's like a stick. If you have a small stick like you do, it only moves this far out here. If you have a larger stick, it moves a lot further out. The percentages are the same. The movements are so much bigger. Good job.
So we're looking at exiting trades in multiple different spots. So we're looking at conservative, 30, 50, 70% of the initial credit, and then 100% and 200%. Those are kind of the 100% and 200% are the ones that we've looked at for short premium positions as a time where if you're going to use stops, that's kind of your mental stop. This, we're going to look at spreads, which inherently have a lot less risk, and they're going to be closer at the money. That's kind of the big thing here is that, the times that you're using these stop losses are on these big lows. They're happening quickly. So of the trades, so when you're looking at the calls versus the puts, obviously the puts have worked over the last 10 years. Look at any chart, put side if you are, but then you get days like today where they remind you.
Yes.
Sometimes the market goes down. So it's easier said than it goes to kind of the SPX trades. We're talking about much easier said than done. And, there's no crying in the casino. So when, things don't work, don't be a little sissy about it. Okay. You got to take some risks. So positive delta has worked over the, this year and over the 10-year average versus, doing these on the call side. But you have to keep in mind that, there's merits to both sides day to day. To the next slide here. So with just decreasing success rate, traders are looking for further protection on top of their risk-defined strategies in order to increase your return on capital. One solution is to use stop loss if you so choose. We do this by staying small. You're trading bigger size. Maybe you look at this. And so we're looking at different stop loss metrics here. So jumping to the next slide here. So looking at the percentages. So we've kind of bucketed this into, and I don't like the high risk, kind of metric here, but it is a higher risk. But we've kind of isolated these into, really conservative. If you're very kind of risk averse, if you're kind of in the trader mindset, you should be looking at like the 70, 100, 200%. Like that's kind of our realm. But if you're looking at kind of these ranges, we've bucketed this based on your risk tolerance here across the board. So you'll see on this next slide, using no stop loss is kind of the one that you should be doing because your win rate is your average P&L, it's the highest. Your win rate is going to be the highest. Your average return on capital, it's going to be the highest. Like this is where you should be trading. And it's intuitive because you're defining your risk on entry. You have the stop loss baked in. You don't need a second stop loss here. The 50 to 70 range if you are going to do some sort of stop loss, is where you can think about it on a spread trade. And all it's telling you is that you're basically avoiding the tail risk events. You're giving up a lot of the profitable trades because some of these trades come back, but you're avoiding the big tail risk. Because on a day like today, if you sold a put spread yesterday or last week or 2 weeks ago, and it's 45 days out in time, it might be 30, 40 points, or not in SPY, because SPY hasn't moved that much. It might be 10 or 15 points in the money. Right. But the spread hasn't moved. And that's because you've been helped by volatility. The trade has a lot of time left. It's telling you that right now, if you have a junky put spread, you can take it off right now and eat the loss, and it makes sense.
Agreed.
Most times.
Now, I wish I had that discipline.
I know I don't have it either, and I don't think if you're.
That's why I sell the other side. That's my discipline.
You take advantage of the volatility.
That's correct. That's the
not run away from it. Like I think this is the situation where you say, okay, I'm only out.
Lost, which is a good quality to have.
Yes.
Like, I probably only have one marriage if I had that quality, but I just can't. I mean, I just can't admit when I'm wrong, and I'm going to sell the other side. More
I agree with you. I think the point here is that the death by paper cuts is more painful than taking a little heat.
Shark G used to text me every day when volatility was in the, a couple of years ago with 12, 13 handle. And it's like, we would have $5.
I can't take it. I can't take it.
Death by 1,000 cuts. I mean, death by 1,000 cuts. He has said it so many times to me that when I hear it, I cringe to my bones. Like
he lost so much money that now his son is in servitude. his son is paying off the dets.
Poor bastards.
Like us.
Yeah, like us. That's right. We know how it feels.
So getting to the next slide here. So we're at, we're at slide 7. Yes, perfect. So the SPY tested, so looking at the put spreads here, the 50 to 70% stop area, you mitigate some of those big losses of big drawdowns. I think if you're trading too big, you have to start thinking about this. If you are trading in a normal size, you just kind of stick to the no stop loss and manage your trades and be fine with it. But I think the key takeaway on this is that, these stop loss, the points where they make sense are when you're looking at it. And as a trader, you should intuitively know this, that, on a day like today, if you're short put spreads where vol is increasing, that you have no vol exposure on a put spread. And so the pop in vol helps you because now your long option is closer at the money. And instead of losing $2, you're only losing $1, $1.50. It hedges you into those sort of moves, especially on the put side. And so, that's really the big takeaway here.
Totally agree.
The last slide here, just go to these takeaways real quick. So stop losses do help improve your efficiency in some regards there. So adding a stop loss or just putting the spread on as a spread trade at entry, that 50 to 70% of the credit. So like if you sell something for $1, when it's trading at $1.50 or $1.70, that's kind of where you can look to use those moderate stops. Using too tight of a stop is going to be death by paper cuts. If you have no stop order on these at some point into the future, and by stop order, like at the 21-day mark, closing the trade is your stop order.
Yes.
And you got to be kind of consistent with it. You can't be picky and choosy here. Everybody gets caught.
What happens. You put these stop orders in and you get stopped out. And the first time it goes against you the other direction, you're like, I'm never using these again. And when you get stopped out and it continues going in that direction, you forget about it. Like it doesn't, that it helped you. Like you forget about it. And that's why if you sell the untested side, at least in my opinion, if you sell the untested side, it keeps you in the game. It reduces your delta risk by some percentage, typically 30 to 50%. And if you're doing that, you're kind of giving yourself a stop halfway. Like, you're not completely stopping yourself out, but you're stopping yourself out by some percentage. You're not in the purest sense of the word stopping yourself out, but you're reducing your delta by 30 to 50%. And that to me is the key.
Yes, agreed.
That's what I think you have to do.
Good stuff.